Hello and welcome to the April update. My name is Charuk Guptali. I'm a financial advisor at Saturn Advice. I would encourage you to take a pause and have a read through the disclaimer. Inflation is still, a topic of discussion. There has been a concern going around that maybe there is a resurfacing of inflation. There's a rebound happening. And I've shown the US headline inflation in the top left, and you can see the last couple of readings have been on the up. Is that a trend? I think it's a bit too early to say. Yes, it is something to be looked at, but I wouldn't speculate as far as going on to say that there's going to be a rebound in inflation back to much higher level. More importantly, the core inflation is still maintaining a downward trajectory, which is what I've shown in the bottom right. There has been a bit of a flat data point in March, but that is also nothing too unusual. There have been a couple of occasions, as you can see previously, where month on month the data point has been flat. So yeah, we'll continue to monitor that. The markets obviously price and looking ahead. I'll come to that in a bit. Is soft landing still possible? I think it is. There has been a slight slowdown in US consumer spending, as you can see in the top left graph. The latest quarter spending figure has come below the previous quarter, but that too is not really unusual. There have been previous occasions just in that graph over the past 3 years that quarter on quarter US consumer spending has come out below the previous quarter figure. So it's just that in this particular month, there have been data points which have just come together and all have looked slightly negative or, not as per expectations. The US GDP growth rate also came out slightly weaker, as I've shown in the bottom right graph. Again, this is still a pretty decent annual growth rate at what it is, but it is a bit below than the previous quarter. So there is mindset going around that maybe inflation is rebounding, maybe the economy is slowing down, the consumer spending is slowing down, so the economy is heading for a recession and inflation is heading up. So I'm probably not in that band camp, but probably going to just hold my horses on that and wait for more data points and more evidence to come through. The economy, in my view, is still very resilient and showing good growth. Earnings are beating expectations. What all of this does mean is that interest rate potentially will remain higher for a bit longer. And that obviously has some impact on asset pricing, as the markets, as I said, they price ahead. So the markets took a breather in April, but that is on the back of a really strong 5-month run going back to November of 2023. I have said that before, the markets do not go up in a straight line, and despite the negative month, you can see that S&P 500 1-year return on the bottom left, and it was a very, very positive 12-month period, more than 22% return. But was that in a straight line? No. There were positive May, June, July last year, and then there were 3 negative months in August, September, October, and then a really strong, almost straight line-ish run up until end of March, and then April has been negative. But that is the nature of markets. They go through these cycles. They have a strong run and then they take a breather and then get on with the next run. But obviously, news have to be watched. In the absence of any major negative information that has not been priced in, I would expect the markets to continue on from after a bit of a pullback. So yes, geopolitics is a bit elevated, just the geopolitical tension, particularly in the Middle East, but even Iran and Israel, neither of them seem inclined to escalate this conflict. It's more like a show of strength than wanting a full-blown war. I have shown the NZX50 on the right. The 1 month performance is slightly less negative than the S&P 500, but over the past 12-month period, it is a major underperformance, which again is a bit of a concern if you have a portfolio which is biased towards New Zealand, whether self-managed or through a broker or an advisor. That is something that you should look to diversify. What should investors do? I haven't really changed my view. In fixed interest, still offering a really good proposition, high yields with the potential of capital gains when interest rates drop. I say when. It's not a question of if. Interest rates will come down, but it's a matter of when. In the higher interest rate environment, dividend-paying businesses offer good value. You should look to, if you're wanting to have a play on interest rates coming down, small caps typically benefit quite a bit when interest rates decline. Do not forget emerging markets. China has just set themselves an ambitious-looking 5% target for their GDP growth. But I wouldn't really discount it, given that the government seems very much focused on turning the economy around, and they are rolling out quite expansionary monetary policy at this stage. So, yeah, I'm not going to put a huge discount on their ability to achieve that 5% target come next year. India is continuing to grow, and it's having its general election these days. In a few weeks, Modi is very likely to have another term, which also means that all the foreign investment flowing into India would likely continue, and the government would continue to spend on infrastructure improvements. So the economic growth is very likely to continue over the near to medium term, I'd say. So do not ignore emerging markets. Diversification is important, regional as well as sectoral. Here is an example of some of the funds that we have in our strategies. I've shown only a handful. Australian equity manager, a global satellite equity manager, and what satellite means is there is the core, which gives you a broad spectrum market exposure, and then the satellite is where you want to add something extra to the mix, something like a high growth, a technology focused, healthcare oriented, European regional emerging markets, that kind of exposure to the mix. That is what a satellite fund would bring. So something different, a niche. And then I've also shown the New Zealand equity fund manager that we currently use. And you can see in 1 month, over a short period, one fund manager can really knock it out of the park. The global satellite equity manager for us did so during March, 13.7% in 1 month. And even for the 1 year, the returns can be quite varied. Obviously, New Zealand equity has continued to underperform over this period. The 3-year return, satellite manager, -7%. That's the 3-year annualized return. You would imagine, if someone invested 3 years ago and they're still sitting at -7% annualized, they won't be pretty happy. But if you stay around, the longer term return starts to deliver, despite this negative return over a 3-year period, which is a bit longer, which is unusual, but it can happen. The 5-year and the 10-year return comfortably positive, not something that you wouldn't be happy about. So the key is to hang around and take the ride. The bull markets typically last a few years. The bear markets typically about a year. We've had the bear market through 2022, and the current bull market, as I've pointed out, we are on to the next bull market. Doesn't exactly feel like we are onto it, but we can see that we are into the next bull market. It has a bit more legs, contingent upon nothing major negative coming around, like the next pandemic or major global conflict. This bull market could go on for another 2-3 years, if not longer. So yeah, get in touch with us if you'd like to have a chat or get your portfolio reviewed. one of our advisors will be happy to have a look and have a chat free of obligation. Take care. I'll see you in a month's time.